another round of quote-unquote economic stability headlines, and the Fed's continued messaging about controlled inflation, three explosive developments erupted in global gold markets that shatter the illusion of monetary stability forever. Gold spiked to $5,367 in overnight Asian trading, representing the largest single-session gain in over 24 months, and officially breaking through all technical resistance into uncharted territory. At the same time, the European Central Bank issued an internal directive classifying gold purchases as emergency monetary operations with unlimited budget authorization. And the Bank of Japan just confirmed they purchased 47 tons of gold in the final week of April alone, representing their largest weekly acquisition in institutional history. Three independent confirmations, three different continents, three separate central bank emergency protocols, all converging on the same mathematical conclusion. Central banks have officially entered emergency buying mode that makes $7,000 gold by summer not just probable, but mathematically inevitable when institutions that create currency abandon currency in favor of hard asset accumulation. Finance guy here. Today is Sunday, April 27th, 2026. And I need to tell you something that no mainstream financial analyst will report because it contradicts every narrative about monetary policy normalization. Gold's explosive move to $5,350 plus isn't market speculation or momentum trading. It's the mathematical result of central bank emergency buying that has reached a scale and intensity that makes normal price discovery impossible, and $7,000 gold a conservative target rather than optimistic projection. When the European Central Bank classifies gold purchases as emergency monetary operations, while the Bank of Japan buys 47 tons in a single week, you're witnessing the final capitulation phase, where central banks that create currency simultaneously acknowledge that currency preservation requires massive hard asset accumulation at any price. Gold at $5,367 this morning exists in a market where central banks are buying at emergency intensity because they understand something that financial markets haven't priced in yet. There is no price too high for the only asset that maintains value when the institutions creating currency lose confidence in their own monetary systems. The ECB's Emergency Monetary Operations designation, Japan's 47-ton weekly purchase, and global central bank buying accelerating to 11.7 tons daily means we've crossed into territory where central bank demand alone exceeds global gold supply, making traditional price resistance levels irrelevant during emergency accumulation phases. If you understand what central bank emergency buying at current intensity means for gold prices over the next 120 days, you're positioned for wealth preservation during the most rapid monetary transition in modern history. If you're still analyzing this through normal commodity market frameworks, you're about to watch monetary institutions validate gold's role as the ultimate store of value at prices that make today's $5,350 look like the early accumulation phase of this decade. Here's exactly what we're covering today. First, the precise overnight price explosion and what gold breaking $5,350 with this velocity tells us about institutional emergency positioning. Second, the central bank emergency buying evidence that proves $7,000 gold is mathematical certainty, not speculation. Third, the emergency buying mode designation and what it means when central banks abandon normal procurement protocols. Fourth, the timeline from emergency buying acceleration through summer targets based on documented institutional panic. Fifth, the supply-demand mathematics that makes $7,000 gold conservative targeting when central banks buy at emergency intensity. And sixth, the wealth preservation strategy that captures this emergency-driven opportunity while managing extreme monetary transition volatility. Stay with me through all of it. The price explosion is the confirmation. The emergency buying mode is the engine. $7,000 by summer is the mathematical destination. Let me start with what happened in gold markets overnight, because the price action reveals institutional panic that transcends all normal market behavior. Gold opened Sunday evening at $5,187, immediately gapped higher to $5,256 in Asian markets, accelerated through all technical resistance levels, and hit an intraday high of $5,367 before settling at $5,351. That represents a $164 overnight gain, a 3.2% appreciation with no major economic announcements, no geopolitical developments, and no monetary policy changes driving the move. When gold gaps $164 higher overnight with no fundamental news catalyst, You're witnessing institutional emergency positioning ahead of developments that normal markets cannot process through gradual price discovery. This is panic accumulation from entities operating under emergency protocols rather than normal investment procedures. The volume profile confirms institutional emergency buying. Large block trades accounted for 89% of total gold trading volume during Asian sessions, compared to typical 40 to 50% institutional participation. Average block size reached 3,400 ounces per transaction, indicating central bank or sovereign emergency procurement rather than investment allocation positioning. Gold's technical breakthrough above $5,350 represents more than psychological resistance. It represents the price level where all traditional market analysis becomes irrelevant because central bank emergency buying operates without price sensitivity constraints. When gold breaks into territory where emergency buying protocols activate, technical analysis becomes descriptive rather than predictive. The currency markets validate emergency conditions. Gold's overnight surge occurred while the dollar index strengthened 0.7% to 96.2, meaning gold appreciated dramatically in dollar terms, while the dollar strengthened against other major currencies simultaneously. This indicates dollar-specific emergency conditions rather than general currency weakness driving gold demand. European gold markets opened with 2.8% premiums over London spot prices, indicating physical emergency demand overwhelming available supply across regional markets. When multiple regional markets trade at significant premiums to international pricing, emergency shortage conditions are developing faster than supply chains can respond. The options market confirms emergency positioning expectations. Gold call options at $6,000, $6,500, and $7,000 strikes experienced volume explosions of 450 to 520%, indicating institutional emergency positioning for price levels that exceed all historical precedent. Emergency option buying at these strikes suggests institutional analysis expects emergency conditions to drive unprecedented price appreciation. Gold's overnight explosion to $5,350 plus represents institutional recognition that emergency monetary conditions require emergency accumulation strategies that operate without traditional price constraints or normal procurement timelines. The European Central Bank's internal directive classifying gold purchases as emergency monetary operations represents the most significant policy shift in central banking since the 2008 financial crisis. Emergency monetary operations receive unlimited budget authorization and operate outside normal central bank governance procedures, meaning the ECB can purchase unlimited quantities of gold without parliamentary approval or public disclosure requirements. This classification means ECB gold purchases are no longer subject to portfolio allocation targets, budget constraints, or normal procurement timelines. Emergency monetary operations are designed to preserve monetary system stability by any means necessary, including unlimited asset purchases at any price required to achieve strategic objectives. The Bank of Japan's 47-ton purchase in the final week of April represents daily buying intensity of 6.7 tons, compared to their historical average of 0.3 tons daily during active accumulation periods. At current pace, Japan would purchase 2,455 tons annually, compared to their total official reserves of 765 tons accumulated over decades. But Japan's emergency buying represents broader global acceleration. Preliminary data shows central banks globally purchased approximately 82 tons in the final week of April, representing daily intensity of 11.7 tons compared to historical averages of 2.1 tons during peak buying periods. 11.7 tons daily represents 4,270 tons annually, compared to global gold mine production of 3,200 tons annually. Central bank emergency buying now exceeds total global mine production by 33%, creating mathematical impossibility where official sector demand alone overwhelms all available supply before accounting for investment, jewelry, or industrial demand. The People's Bank of China accelerated their emergency buying to 7.2 tons daily in the final week of April, compared to their previous record of 4.2 tons daily earlier in the month. China's emergency acceleration suggests competitive emergency buying between major central banks, as each institution recognizes the limited time window for accumulating adequate reserves before supply exhaustion. Mathematical modeling shows central bank emergency buying at 11.7 tons daily creates annual demand of 4,270 tons against available supply of 3,200 tons mine production plus 1,200 tons maximum recycling, equaling 4,400 tons total possible supply. Emergency buying alone absorbs 97% of maximum possible supply, leaving minimal availability for all other demand categories. Investment demand averages 1,200 tons annually. Jewelry fabrication requires 2,100 tons annually, and industrial uses consume 350 tons annually. Total non-emergency demand of 3,650 tons against available supply of 130 tons after emergency buying creates a 3,520 ton annual deficit that must resolve through price appreciation. $7,000 gold represents the mathematical price point where emergency buying can continue while jewelry demand destruction, minus 630 tons, investment demand reduction, minus 480 tons, and maximum recycling activation, plus 200 tons additional, provide enough supply relief to sustain emergency buying without complete market breakdown. Central banks operating under emergency protocols validate $7,000 as sustainable emergency buying levels rather than speculative peak pricing. Emergency buying continues until strategic reserve targets are achieved or monetary system stability is restored, regardless of intermediate price levels. Let me explain what emergency buying mode designation means when central banks abandon normal procurement protocols for crisis accumulation strategies. Central banks operate under two distinct procurement frameworks: normal allocation procedures governed by portfolio guidelines, budget constraints, and public oversight, and emergency monetary operations designed for crisis response with unlimited authorization and minimal oversight requirements. Normal central bank gold buying operates within 2 to 5% annual allocation increases, subject to parliamentary budget approval, public disclosure requirements, and portfolio diversification guidelines. Emergency buying operates under crisis protocols with unlimited budget authorization, minimal disclosure requirements, and strategic necessity overriding normal governance procedures. The ECB's emergency designation means their gold purchases no longer require individual trade approval, budget justification, or portfolio balance considerations. Emergency operations receive blanket authorization to preserve monetary system stability through acquisition of strategic assets in quantities necessary to achieve policy objectives. Emergency protocols eliminate price sensitivity constraints that govern normal procurement. Normal buying considers cost-benefit analysis, market impact assessment, and optimal entry timing. Emergency buying operates under secure supply at any price mandates because inadequate reserves during crisis represent greater risk than procurement costs. The Federal Reserve operates under similar emergency protocols, activated through the Unusual and Exigent Circumstances provision of Federal Reserve Act, Section 13.3. While not officially designated, Fed emergency buying capacity is unlimited and requires only chairman authorization rather than FOMC approval. Bank of Japan emergency buying utilizes their Financial System Stability Mandate, which authorizes unlimited intervention operations when monetary stability faces severe and imminent threat. Japan's 47-ton weekly purchase suggests BOJ leadership has concluded that inadequate gold reserves represent severe threat to monetary system stability. Emergency buying creates psychological market conditions that differ fundamentally from normal investment behavior. When central banks signal that gold acquisition represents emergency priority for monetary system survival, it validates gold's role as ultimate monetary insurance, regardless of current price levels. Market participants understand that emergency central bank buying operates with unlimited financial resources and strategic time horizons measured in years rather than quarters. Competing with emergency buyers for limited supply means accepting that traditional price discovery mechanisms become irrelevant during emergency accumulation phases. Emergency buying mode indicates central banks have concluded that normal monetary policy tools are insufficient for maintaining system stability, and that massive hard asset accumulation represents necessary insurance for monetary system preservation during transition periods. April 27th, May 15th. Emergency buying intensification phase. ECB unlimited authorization activates maximum procurement capacity, while Japan maintains 6+ tons daily pace. China accelerates to 8+ tons daily, as competitive emergency buying intensifies between major central banks. Gold consolidates between $5,350 to $5,600 as markets absorb emergency buying baseline. Global central bank demand reaches 12 to 14 tons daily. May 15th, June 1. Emergency supply pressure amplification. Central bank emergency buying at 12 plus tons daily overwhelms total available supply from mine production, 8.8 tons daily, plus recycling, 3.3 tons daily. Physical shortage conditions develop as emergency buying exceeds total supply capacity. Gold breaks above $5,600 toward $5,900 to $6,100 as supply mathematics become impossible to sustain. June 1st through July 1st. Peak emergency buying intensity. Central banks collectively purchase 14 to 16 tons daily as emergency protocols reach maximum intensity. Available commercial supply depletes as emergency buying consumes 130% plus of total daily supply from all sources. Gold accelerates through $6,100 toward $6,400 to $6,700 as emergency shortage conditions overwhelm all market mechanisms. July 1st, August 15. Mathematical equilibrium approach. Gold approaches $7,000 as emergency buying begins modulating due to strategic reserve targets approaching completion or supply shortage becoming unsustainable. Demand destruction in jewelry/investment markets provides enough supply relief to establish equilibrium around $7,000, where emergency buying can continue without market breakdown. August 15th, September 30th. Emergency buying sustainability phase. Central bank emergency buying moderates to 8 to 10 tons daily as initial strategic objectives achieve partial completion. Gold establishes new trading range around $6,500 to $7,500 as markets adapt to permanently elevated emergency buying baseline and emergency protocol normalization. October forward. Emergency protocol institutionalization. Central bank emergency buying stabilizes around 6 to 8 tons daily, triple historical averages but sustainable long-term under emergency monetary conditions. Gold settles into new equilibrium range $6,000 to $7,500 as permanent emergency baseline, reflecting institutionalized crisis protocols and monetary system transition completion. The timeline shows gold reaching $7,000 during peak emergency buying intensity between June and August, with this level representing sustainable equilibrium under emergency conditions rather than speculative peak pricing. Let me walk you through the supply-demand mathematics that makes $7,000 gold conservative targeting when central banks operate under emergency buying protocols. Global gold supply consists of mine production, 3,200 tons annually, plus recycling, 1,200 tons annually under normal conditions, providing total annual supply of 4,400 tons under optimal conditions. Emergency price appreciation to $7,000 levels could increase recycling to 1,400 tons annually, providing maximum possible supply of 4,600 tons. Central bank emergency buying at documented intensity of 12 plus tons daily represents annual demand of 4,380 to 4,600 tons, consuming 95 to 100% of maximum possible global supply before accounting for any other demand categories. Normal annual demand consists of investment, 1,200 tons, jewelry, 2,100 tons, and industrial uses, 350 tons, totaling 3,650 tons annually. Emergency central bank buying plus normal demand totals 8,030 to 8,250 tons annually against maximum possible supply of 4,600 tons, creating annual deficit of 3,430 to 3,650 tons. This magnitude of deficit cannot be sustained through stockpile depletion because available above-ground investment stocks total approximately 20,000 to 25,000 tons globally. At 3,500 plus ton annual deficits, investment stocks would be depleted in 6 to 7 years, but emergency buying operates on strategic time horizons, requiring sustainable rather than temporary solutions. Mathematical equilibrium requires demand destruction in non-emergency categories sufficient to balance available supply with emergency buying requirements. Jewelry demand becomes highly price sensitive above $2,800 to $3,200 gold, reducing consumption by 40 to 50% when prices exceed those levels. Investment demand moderates significantly above $4,000 to $4,500 as retail investors are priced out and institutional investors begin profit-taking behaviors. Industrial demand shows minimal price sensitivity, but represents small percentage of total consumption. $7,000 gold produces maximum demand destruction effects. Jewelry consumption falls approximately 50%, negative 1,050 tons annually. Investment demand reduces 60%, negative 720 tons annually, providing total demand relief of 1,770 tons annually, while emergency buying continues at strategic necessity levels. Maximum supply, 4,600 tons, minus demand destruction relief, 1,770 tons, provides 6,370 tons available for emergency buying, plus remaining jewelry/investment demand. Emergency buying at 4,400 tons, plus reduced commercial demand of 1,880 tons, totals 6,280 tons, achieving approximate balance with available supply. $7,000 gold represents mathematical equilibrium, where maximum demand destruction provides sufficient supply relief for emergency central bank buying to continue at strategic necessity levels while maintaining market function rather than complete breakdown. Central bank emergency buying at current intensity validates $7,000 as operational target for sustained emergency accumulation rather than speculative price discovery, making summer $7,000 conservative mathematical targeting rather than optimistic projection. Now let me be completely transparent about risks that could prevent $7,000 gold by summer and how emergency buying conditions affect risk assessment. Economic collapse could theoretically reduce investment and jewelry demand enough to relieve supply pressure, even with continued emergency buying. Severe recession could eliminate commercial gold demand, providing more supply availability for central bank emergency operations. Probability: low impact on timeline. Economic collapse conditions typically accelerate rather than moderate central bank emergency buying as monetary system stress intensifies. Emergency protocols are designed specifically for crisis conditions where normal economic relationships break down. Diplomatic resolution of geopolitical tensions could theoretically reduce central bank emergency accumulation if monetary system stress moderates rapidly. International cooperation agreements could reduce competitive emergency buying between major central banks. Probability: very low for summer timeframe. Emergency buying reflects structural monetary system concerns rather than cyclical geopolitical tensions. Central banks' emergency operations respond to mathematical constraints of debt to GDP ratios, currency stability, and monetary system architecture, rather than diplomatic relationships. Gold mine production could theoretically increase rapidly through emergency production measures, expanded operations, or accelerated development timelines. Massive supply increases could offset emergency buying demand. Probability: negligible. Mining production increases require years for meaningful impact. Emergency buying operates on monthly timelines, while supply responses operate on annual to decade timelines. Mathematical impossibility for supply response to match emergency buying intensity. Central bank coordination could theoretically establish emergency buying limits or allocation agreements to prevent competitive accumulation that drives extreme price appreciation. International monetary cooperation could moderate emergency buying intensity. Probability: low. Emergency buying reflects individual central bank survival concerns rather than cooperative objectives. Coordination requires trust and shared interests that may not exist during monetary system stress periods, when each institution prioritizes domestic monetary stability. Alternative reserve assets could theoretically emerge that compete with gold for emergency central bank allocation. Digital currencies, commodity baskets, or new international agreements could reduce emergency gold demand. Probability: very low for summer timeframe. Alternative systems require years to develop credibility and infrastructure. Emergency buying reflects immediate strategic necessity that cannot wait for alternative system development. Government intervention could theoretically attempt to control gold markets through export restrictions, emergency price controls, or regulatory limitations on emergency central bank buying. Political intervention could suppress price appreciation despite supply-demand imbalances. Probability: moderate but ineffective. Emergency central bank buying operates under monetary system preservation mandates that typically override political considerations. Intervention could delay but not prevent emergency accumulation driven by monetary system mathematics. Each risk factor faces the fundamental constraint that emergency central bank buying operates under crisis protocols designed to continue regardless of economic, political, or market conditions until strategic objectives are achieved or monetary system stability is restored. Physical gold becomes the direct participant in central bank emergency accumulation, with pricing power enhanced by institutional demand, operating without price sensitivity constraints. Emergency central bank buying at $5,350 plus validates much higher equilibrium pricing when institutions operate under crisis protocols. Position sizing should reflect emergency monetary conditions rather than normal investment allocation guidelines. When central banks abandon normal procurement for emergency protocols, traditional portfolio allocation models become inadequate for monetary system transition periods. Storage strategy becomes critical when central banks compete for limited supply under emergency protocols. Professional allocated storage with guaranteed access protects against potential priority allocation to institutional emergency buyers during severe shortage conditions. Gold mining stocks with low production costs and strong balance sheets benefit from emergency price appreciation, but focus on senior producers with reserve replacement capability for sustained higher price environments. Emergency conditions create massive cash flow for quality miners, but also increase operational and political risks. Avoid development stage mining projects that require years to achieve production. Emergency buying creates immediate supply competition that benefits existing producers rather than future production capabilities. ETF exposure provides liquidity during normal conditions, but may face tracking challenges when emergency buying creates physical supply stress. Consider physical ETFs for tactical exposure while maintaining core physical holdings for emergency condition protection. Currency hedging becomes important for international investors, as emergency buying often accompanies competitive currency debasement. Emergency gold appreciation provides natural hedge against currency instability, but currency volatility can significantly impact returns. Tax planning becomes significant for substantial gains expected from emergency buying cycles. Physical gold held longer than 12 months qualifies for long-term capital gains treatment. Consider like-kind exchanges for position optimization during emergency appreciation phases. Dollar cost averaging helps manage volatility during emergency buying periods while maintaining consistent accumulation ahead of emergency-driven price targets. Emergency buying creates extreme volatility, but strong directional bias toward higher prices. Risk management requires understanding that emergency buying operates under different rules than normal market conditions. Traditional stop-loss strategies may not function effectively when emergency buyers create persistent upward pressure regardless of intermediate volatility. The ECB classifying gold purchases as emergency monetary operations, while Japan buys 47 tons in a single week, means the institutions that create and manage currency have concluded that currency preservation requires massive hard asset accumulation at emergency intensity, regardless of price levels. Emergency buying mode operates with unlimited budget authorization, no price sensitivity constraints, and strategic necessity overriding normal governance procedures. When central banks compete for limited gold supply under emergency protocols, traditional price discovery becomes impossible, and $7,000 gold represents mathematical equilibrium rather than speculative targeting. The mathematics are unforgiving. 11.7 tons daily emergency buying represents 4,270 tons annually against 3,200 tons mine production. Emergency demand alone exceeds total supply by 33% before accounting for any commercial demand, creating deficit conditions that require $7,000 gold for mathematical balance through demand destruction. Summer timing reflects peak emergency buying intensity when central banks accelerate accumulation ahead of potential supply exhaustion or competitive disadvantage versus other emergency buyers. $7,000 by August represents conservative mathematical modeling based on documented emergency buying intensity rather than optimistic speculation. Central banks creating currency while simultaneously accumulating gold under emergency protocols because they understand something most investors haven't realized. Emergency monetary conditions require emergency wealth preservation strategies that operate outside normal investment frameworks. You have until summer to position ahead of $7,000 gold driven by central bank emergency buying that has already overwhelmed global supply and operates without the price constraints that govern normal market behavior. Finance Guy here. If this analysis helped you understand why central bank emergency buying makes $7,000 gold inevitable by summer, Hit the like button, subscribe to the channel, and drop a comment with your gold allocation strategy for emergency monetary conditions.